On today's podcast, I had Chris Naghibi on. Now, Chris is a man of many different talents. He has a real estate portfolio of over $50 million. He's also a lawyer who does pro bono work. But the biggest thing that he's doing right now is he is a part of a bank doing over $10 billion worth of investments last year. He helped start it, he helped it go public, and he's continuing to help grow that business. But in this podcast, we talked about a lot of different things going on in the economy, especially as it relates to banks. As a guy who's had maybe mixed feelings about banks over the years, like many other people, I got to ask him what exactly goes on behind the scenes with banks. Why do they have a negative stigma? What happens when you deposit money? How do they make these loans? Where do they make their money? It's a really interesting thing to listen to. But along with that, I get his perspective on going public. He ended up taking his bank public about 7 years ago, and is some good insight for me as I potentially take a company public one day, and what are the do's and don'ts, and why it may not actually make sense for most people. And towards the end of the podcast actually is my favorite part. We started actually getting into some conspiracy theories. There's some really interesting things happening in the economy. We've got a war going on now. We've got a lot of money printing, and we talk about whether we think interest rates are going up and really what's happening with the media. So I think you should watch it all the way to the end. It was one of my favorite episodes we've done. Now, with that being said, let's jump into it. Welcome to the Ryan Pineda Show, where our mission is to invest.
I only expect to make money in things that I understand.
Innovate.
It's about believing in the future and thinking that the future will be better than the past.
And inspire. I am much more likely to hit my goal just due to putting it out there.
You're now rocking with the best.
What's going on, everybody? Welcome to another episode of the Ryan Pineda Show. Today, I've got somebody who's taken a bank public, who's done over $10 billion worth of deals. And not only is he doing the banking industry, he's got a law firm that does a ton of pro bono work. He's a real estate tycoon, amassing a lot of big properties and different things. And it's really cool to have him on the show. I've got none other than Chris Naghibi. Did I say it right?
You did, yeah. Thanks, man. That was a solid intro. I just consider myself to be a real estate guy, but yeah.
Dude, when I look at you, I'm like, this guy's a lawyer. He's a bank guy. And then I'm like, oh, yeah, and he also owns real estate. So for everyone who doesn't know you, like, give us the brief rundown of what exactly you're doing.
You know, it's harder sometimes to explain myself. I started off in law school and thought that was going to be something that I wanted to do, but the reality of the law school experience was that it wasn't for me. It was something that my parents always told me you had to be a doctor or a lawyer, so I went down that path, and I didn't enjoy it at all. At the time, I was working in real estate anyway. I was an underwriter for a multifamily shop, and I really liked what I was doing. It gave me insight into all these wealthy people's financials and how they made their millions and how they acquired all these beautiful properties that I could only aspire to have, and I thought it was really cool. Flash forward, and there was an opportunity to join a team that was starting a bank, and I took that opportunity. I started off very low. I thought I was just going to be an underwriter there, and now I'm executive vice president, chief credit officer. I tend to forget my role some days, but it's been 14 years. We took the bank public, but that wasn't enough for me. I ultimately decided that I wanted to keep challenging myself and to keep growing, and in order to do that, I thought I'd go back to some of the things that I maybe probably didn't have the maturity to appreciate when I was younger. So I took and passed the bar. Ultimately, that was fun, and I wanted to use that and really sharpen up my skills, so I started the law firm for more of a pro bono endeavor. I figured I was lucky enough in what I was doing that kind of made sense, and I never gave up the passion for real estate, so I was always buying for myself when I could. It was just getting the money to do it.
Right. So, I mean, to take a step back, like, how did you even get to that point? Like, when you're growing up, man, like, what did young Chris do? Like, how did you even get there?
I was not the greatest student, man. I was in high school. My dad's Iranian, and my mom and dad split up, and I was with my dad. And my dad had this old school mindset: you had to be a doctor, you had to be a lawyer, and they just whipped school into me. Mm-hmm. My dad was super hyper aggressive with it, and that's what that generation knew: is you went to school, you got taught to raise your hand and do the right things in class, and that's what I thought you had to do. But I wasn't really good at it. It didn't come very naturally to me. So I knew early on that sports was kind of my outlet, and I played basketball. That was what I did. I wasn't the world's greatest, but I was 6'5", and I was in great shape. And I really, really wanted to do that as a career, but my dad would have never in a million years let me do that.
Why?
You know,
Just the immigrant parent thing?
the immigrant parent thing on some level, on another level, I don't think my dad was never a sports fan anyway, so he didn't really have an appreciation for it.
Right.
But I would say that he never really came to a game, never really, got involved, so he didn't really see there was any possibility of making money. And I think when I was younger, it was a little bit like, hey, parents don't understand it. But as I get older, it's just your parents who wanted you to be stable. They wanted you to be successful. And I don't think he and a lot of parents understand that there's other money to be made. You can go overseas and play sports now. You can coach. You can do so many other things from it. But parents, when you're younger, they don't necessarily see that. They just see your love for the game and see you're going to be disappointed.
They see it as what it is, a game.
I mean, right?
Yep.
So ultimately, you make the decision to either stick with it or not. For me, I chose college. I kind of knew, and you probably knew this too in your space when you were playing baseball. I knew that the league minimum, which was the best I would ever be if I ever got to the NBA or something like that, was going to be probably 350 at the time, 360. And I knew that my expiration date was probably going to be late 30s at the most, given that I wasn't going to be a marquee player for anybody.
Right.
So my career earnings wasn't going to be that great. So why run down a path when I think I could have more longevity, make more money in business?
Mm.
So I made the cognitive decision to step away from playing basketball as much as I did and to really focus on the one thing that I loved doing, and that was working. So even though I went to college, it was always a struggle.
Were you working while you were in college?
The whole time, yeah, full time.
Like, what were you doing?
I started off cold calling single-family residential leads in a single-family brokerage shop, and I had a really deep voice. So even though I was young and knew nothing about real estate,
experienced.
yeah, I came off experienced, and that did okay. And then I kind of graduated, and then from that, into processing, and then ultimately loan underwriting for single-family. But I kept asking questions of the people that I was working with about multifamily. I wanted to know how the apartment complexes and all the complex commercial stuff worked, and they couldn't tell me. So I applied. This is a great story. I'll make it quick. I applied for a job in commercial real estate for multifamily underwriting.
Right.
And the woman I applied for a job with knew the whole time I was lying.
Mm.
I was so shocked I got the interview that I went the day before the interview when they told me that I got it and got an MBA book from, I think it was a Barnes & Noble. And it was total happenstance that I even found a book on this topic. And it was all about debt service coverage ratio, net operating income, and how the multifamily space worked from an MBA perspective. Not real world application, but enough to give me the terms. So I read as much as I could and went into the interview feeling super confident. I was gonna snow her into thinking that I had some experience and I was the right guy. Into the interview, she closed the door. She told me straight up that she knew I was lying. And I looked at her and I thought, oh, damn it.
This is when you're in college.
This is when I was in college. I
Yeah.
was actually in law school at the time.
Okay.
I explained to her that I was in law school and that nobody wanted to hire me because they all assumed that I was going to become an attorney and, become successful or something or make money and leave or pass the bar or whatever it was. And I told her that I didn't. I had a passion for it. My dad was in real estate. This is kind of the business that I've always loved. And she hired me because her daughter had the same experience because her daughter was in law school and couldn't get a job.
Oh.
And if it wasn't for that one opportunity, I probably would have never gotten in the commercial space because nobody would have given me the shot.
Right.
So that's kind of where I learned to underwrite deals, and that passion just kept going on and on. I love multifamily. It's to this day, we're the second largest lender in California for multifamily real estate, First Foundation Bank to bank, and we do quite a significant amount of volume in that. I think we did around $3-4 billion last year.
Crazy. And was that nationwide or was that just in California?
Essentially, it's nationwide. We just bought another bank in Florida,
Yep.
So that was a $2 billion acquisition, effectively. And that we now have merged together, so it's public record, obviously. We have 3 locations there in Florida, based out of Naples. And, we're looking to grow and scale more. We have our corporate headquarters now in Dallas, so we're kind of growing out in that area too. So now you really kind of have that smile state, if you will, perspective. We do follow customers into other states, but right now, because banks are required to lend in their primary lending area, anywhere we take in deposits, we don't generally go to states that we don't have deposits in.
So I was about to ask that. Like, okay, you guys said you're the second largest in California.
Mhm.
If you can lend nationwide, why be in California and pay the taxes and deal with that?
Oh yeah, there's a lot to unpack there. So we started in California, so that was just the natural progression of things. But the California tax rate has gotten a little out of hand. I think we can all admit to that, right?
Right.
The single family environment there is so difficult to really get a good investment property if you're an investor that it makes sense that if you're starting off or you're somewhere else, you go somewhere else. But a lot of these California real estate investors have money in multifamily apartment complexes, and that happens to be a very, very dense MSA. California has one of the largest multifamily environments, I think next to Los Angeles, and even actually Florida's coming up now too, some of those larger, denser areas. So California just has a natural density to it, but California also has rent control, which if you're a bank and you're lending in that space, there's always upside potential for increased rents over time. So even though it constrains the debt service coverage ratio, it constrains the cash flow, the ability of for them to get a higher dollar amount, that's actually good for us as a bank. Our average loan in our portfolio is around 58% loan to value on the multifamily side because the land values are so high and you just can't get the cash flow up high enough, especially with rent control environments. We did move.
Are you saying it's good for a bank because you're requiring them to put more down?
Yeah, because if you're in a multifamily property, your ultimate loan amount is determined by your cash flow of the property. You don't get. It's not like single family where you go.
The
in
rent
and
control
say,
makes it a safer loan for you.
Yeah, for us anyway.
Yeah,
and it's more challenging.
It's bad for
obviously,
me.
Bad for you.
I wouldn't want it.
You would. It would take a longer time to get your maximized potential.
Right. Okay. So go on.
So we moved our corporate headquarters to Texas for a number of reasons, not the least of which is the tax environment and situation in California being challenging. Plus, a lot of the California investors are now looking in places like the Midwest.
Right.
So it made sense that we were there. And I personally own real estate in California and Texas. So for me, it was a natural progression for my own just kind of geographic presence.
Right. Yeah. So you guys do that. You expand the bank. While you were doing that, so like, was this bank, was that the same job that you got out of college? Like this girl was telling you?
No.
So what happened?
Guys, this is ironic timing given what's going on in the economy now. So it was October 2007 we started the bank. And about 60 days before then, I was working for Impact Commercial Capital Corporation. That was the job.
That was the one that the girl hired you.
The girl hired me, and she taught me everything I know about multifamily and commercial real
How long
estate.
did you work for her?
I want to say it was about a year and a half, maybe 2 years.
Okay.
It's been a while. It's been kind of fuzzy. Somewhere around the year and a half mark. It wasn't a terribly long time by any stretch of the imagination.
Yeah.
And now we're in the beginning of the Great Recession.
Right.
So the company who had a huge single-family lending arm issued what was a 60-day warn notice. And it's kind of a nuance-based law, but effectively, unless something, quote, changes in the next 60 days, everyone's laid off. So it's really hard to motivate everybody. So we all did resume working shops. We all tried to get everybody jobs, and we were all hoping that everybody would have a job placed by the end of the 60 days.
And this is you at this bank that you just joined.
No, this was me at the previous lender, and this is how I got to the bank.
Oh, okay, I got it.
Right.
Got it.
So one of the girls that was in that group, it was her and I in the last, I would say, week that we were there, day 59 or so of this warn notice, where everyone's going to be laid off unless we get other jobs or something changes. Well, nothing changed, and we were all ultimately laid off. But on day 59, one of the underwriters went to go interview for this bank, a job this startup bank had available. It was then an underwriter.
Right.
She comes back, hands me a business card. I knew right away from the business card that it was one of the three gentlemen who sold Commercial Capital Bank to Washington Mutual for $1 billion. They were in my backyard, and I knew that he was the CEO of this new bank, or to be formed bank.
Right.
Called him up, scheduled an interview that day, and then went and got drunk because I was then officially, quote, laid off because my other job was gone.
Okay.
I got a call while I was mildly intoxicated saying that I was welcome to come on board and the position and the kind of the breakdown, but I was now employed all of a sudden, like in the next hour. I wasn't expecting to have a job again, and there I was. And that's where the bank started.
So that bank was just starting when you got hired. Like they hired you to...
I was hired September 2007. The bank opened in October 2007.
Okay, so like the next month.
The next month it opened to the public, and I was not prepared for the amount of work that went into that.
Yeah, like what did you think you were going to be doing?
I thought I was just going to be an underwriter. I thought I was just going to underwrite stuff, and that was it. But yeah. I was the underwriter, the processor, the analyst. I was
like any startup. You're wearing a lot of hats.
You're wearing a lot of hats, and the gentleman who's supposed to be the chief credit officer is still a very close friend of mine to this day. He wound up having, I want to say it right, but adult onset diabetes, and it really, really affected him. Plus, I think he came from more of a C&I or traditional business lending background, and this bank was scaling at such a rapid pace. I mean, we still are. That ultimately it was clear that I was going to be the successor in time to that role. And as I started to do more and more things and wear more and more hats that he couldn't do because he was always in that more of executive role, it just became clear that I was the guy running the shop.
If you're listening to this podcast, then my guess is you're interested in real estate investing. Some of you are just starting out, while others are trying to scale their business to the next level. But the problem is, with so much information out there, most people don't know which program or coach to trust. Well, I'm a bit biased, but I believe my company, Future Flipper, can help you get to the next level. We've coached thousands of students from all over the world on how to build their real estate investing business. It doesn't matter whether you want to flip, wholesale, or buy rentals. Our coaching program has everything you need to become a great investor. There are many things that we include with coaching, but to give you a few examples, you're going to get an accountability coach. These are people that have had success in their own business, and they want to make sure that you achieve success in yours. We also have all of our documents, our systems, and processes that I've used to buy hundreds of homes. You can copy and paste them directly into your own business. And we have events where you get to meet me, top-level guest speakers, and other students who are crushing it. My students do deals with each other, and I personally do deals with them too. In fact, at a recent event, I just honored over 20 people in our program that made over $1 million in the last year. So if you want to grow your real estate business, head over to futureflipper.com and apply for a call with our team. The call is completely free, and they can help point you in the right direction whether you work with us or not. So go to futureflipper.com and book your call today. For the last year, the real estate market has been on absolute fire. Prices are at all-time highs, interest rates are at all-time lows, and there is more money in the economy than ever. But with so much competition, many investors are sitting on cash, struggling to find great deals. If this sounds like you, then you need to invest with Pineda Capital. With my network and social media following, we get access to the best real estate deals all over the country. And if you're an accredited investor, you can invest with me on those deals. In fact, last year we purchased a 334-unit apartment complex in Georgia for almost $20 million. We expect it to be worth well over $30 million when it's all said and done. Our goal with each deal is to build in so much equity from the beginning that we're able to refinance our investors' cash out and own the properties together with little to no money into the deal. And the best part is, you don't have to do anything. Our team will find the deals, handle the renovations, get them leased, and eventually refinanced or sold. All you have to do is provide the capital. So if you want exclusive access to our deals before they hit the public, go to pinedacapital.com to schedule a call. We can put your money to work today to start getting you great returns. So go to pinedacapital.com now to get access to our deals. So it's funny, man, because I feel like I'm always in the startup environment, right? Like, yeah. I mean, we're organized and doing things, and you know, just like you mentioned, we're always figuring it out as we go along. You know, people are wearing a lot of hats initially, and then we start to see who settles where. But I think what's cool for me to hear is, like, even starting a bank, you guys still just start like everyone else.
It's the exact same thing.
Yeah.
It has this stigma to it because you have a business
I would
plan
think you're already like professional, like you guys are ready to roll.
No, you kidding me? No. I'll tell you how unprofessional it was, and I'm sure I'll get judged for this. But effectively, we had this office space that we rented out, no cubicles. Those hadn't come yet.
Yep. We
had offices because it was somebody else's tenant improvements that we moved into. So there was offices along the walls, but there was a wide open space. We were playing football and throwing the football around the wide open space and talking, and we had alcohol, at the desks, and we were just starting a company. It was the same rules and that everybody else lives by. There's this huge stigma to banks and there being regulated, environments. It's like any other business.
Yeah,
it really is.
You just lend money and hold money, and
well, you got a regulatory plan. In the first 3 to 5 years, you're under what's called a de novo period. So the regulators come in consistently and frequently to make sure that you're following the plan and that you're getting deposits at the pace you said you would, and that you're making loans like the way you said you would, and that you have proper, quote, credit call. I mean, if you're FDIC insured, the FDIC is constantly coming in because if they're giving that insurance on the deposits that you lend or that you lend against, they want to make sure that you are doing the business right.
Right. So whoever founded the bank, who founded it that hired you?
So Scott Kavanaugh is the CEO, and so he got together with, I want to say, about 50 million-ish in capital. Don't quote me on the capital numbers. So we actually grew out of this. This is an interesting story as well. There was a group called the Keller Group, which was a then existing wealth management company. Basically, if you had a lot of money and you were a high net worth individual, you went to them and they managed your money for you, right?
Right.
Typical wealth advisor structure. They were approached several times by other banks about buying them, and they said, you know what? No. And then eventually Scott and Rick, the CEO and chairman of the wealth advisory group, got together and said, well, why don't we start our own bank? Scott had just left Commercial Capital, where they'd sold it to Washington Mutual for $1 billion, and he said, let's do it. Nobody knew that 2007 was going to wind up being what it was, and that initial conversation for those two gentlemen took place in 2005.
Okay.
So they started ramping up when the economy was still good.
That's what I was going to ask. What possessed him to start a bank then? But it was already so far along.
But the timing was actually phenomenal, too. When you think about it, all the banks were not lending. Nobody was making loans. It was really tough to get any kind of
Because
business activity going.
all their loans went bad.
There was a huge liquidity crisis, right? And their loans were going bad, and they had to call money back. So what happened for us? I got the opportunity to walk into the first transaction I did that was large. I walked into Citibank, who was having a liquidity crisis. There was this, I kind of want to say like November-ish, maybe December. And I got to handpick $50 million in stabilized multifamily loans that we could buy from them. We had the capital that we just raised, and we started this bank. We opened the doors in October. We walked into profitability almost immediately because I was able to do that. Had it not have been for the crisis, I would have never had that ability to buy performing loans that fast.
What kind of discount did you get buying those?
It wasn't a massive discount because to us, we were getting the performance, but they needed liquidity badly. So I want to say it was around 99.5 or something like that.
Yeah.
It's been a long time.
Yeah, you just bought straight into, you didn't have to do any work.
No work. We bought literally performing notes. Now, keep in mind, the multifamily stuff is usually 3, 5, or 7-year hybrid. If you're lucky, you get a 10-year product.
Right.
And those guys tend to refinance at a much quicker pace, but there's usually prepay protection.
Yep.
So.
Yep. Yeah, we've learned that as Pineda Capital has gone along, looking at various deals where there's all these prepayment penalties, and we're like, all right, well, I guess we're taking over the loan because we can't refi or get a new loan until these kind of pay down a little bit.
But the assumption clause, which is prevalent in almost all those documents, is a 1% assumption fee, and you can step in the shoes and assume it.
Yep.
So that's going to help you guys out tremendously as the economy shifts, especially as rates rise. You can buy into existing rates if you wanted to and write out the rest of the term and then, do whatever improvements you got to do.
Exactly. Yeah. No, it's been an interesting thing for us as we've gone down the multifam space. So, you get into it in this hectic environment. You guys walk into profitability. You're kind of learning the banking game as you go along. How's it progressed since then?
It's been a steep learning curve. I think for me, going from the lending world and really being on more of your side of the business when I was younger to this side of the business has been challenging in that there are so many regulatory agencies. There's the SEC on one side. There's the FDIC. There's the, DFPIs. They just changed their name. They used to be the DBO, California Department of Financial Protection and Innovation, I want to say. There's just a lot of players in the game and a lot of rules. And you have to know the rules and you have to live by this code that you set out. My job is to be the one who kind of architects the credit policy or that code. But it can become very complex. And in order to make discretionary lending decisions, I think a lot of people think that when you go to a bank, it's as simple as yes or no.
Right.
But there's a lot that goes into that thought process. And being able to gauge what you can and can't do without running afoul of your regulators and without upsetting your customer can be very gray.
Yeah. No, 100%. So to me, I think banks, ever since the crash, have had a negative stigma, right?
Oh, yeah.
They're like, dude, these guys caused the crash because they're greedy, Wall Street guys, whatever. How do you see the banking industry today, like, since then?
I'll never forget. I walked out years and years and years ago. I was on a date, and I was in San Francisco, and I walked out and saw this giant black rock in front of a building in the financial district, and a banker walks out, African-American guy, super nice guy, walks out and says, hey, can I take your photo? I'm with the girl, takes a photo of us. And he's like, you know what that rock is? And I said, no, what is that? And he said, that's the banker's heart. And the light bulb went on for me that I was officially a banker, and that impacted me. That's what bankers were. The connotation for banking is still negative in a lot of ways. I think people think that bankers get paid a tremendous amount, and I'm not going to say that they don't. They do, myself included. I'm very lucky to be in the position that I'm at and have what I have. But I will say that banks, from an investor perspective, from a guy who's built his own real estate empire, if you will, they can be your best advocate, but you have to be willing to play the game by the rules that are there. A lot of people try to rebuke the system or get really upset with the way that the system is put in place, but there's always ways around things. I think one of the most common challenges I see people say is they get frustrated with these large big box banks, the Chase, the Wells, the B of A.
Yep.
I think you and I have talked about it before. Your community banks, your regionals, your super regional banks, they have looser credit standards. They have more of an understanding of your business. They want to get to know you. They want to make loans to your business. They want to get involved with the community. And because of that, they have this ability to be more flexible and a higher likelihood of talking you through things as opposed to just giving you a flat out no.
Right.
So I do think the paradigm around banking is changing, but it's going to take time. And this next crisis, whatever it looks like, I don't even think real estate's going to lead the way or be a huge factor in it. But whatever it looks like, as long as banks perform and there's not a huge run on the banks, I think banks maybe be rehabilitated a little bit, I guess.
Yeah. No, 100%. What do you think? I mean, as far as crypto goes,
I love crypto. I love it.
are you allowed to love it as a banker?
Yeah. Yeah, I hold Bitcoin. I do hold Doge. Don't judge me. And I hold Ethereum. I know you dumped a lot of yours and then got back in and had mixed feelings about it. I've always loved the space. We actually have a partnership with NYDIG. Are you familiar with them?
No.
New York Digital Investment Group, I believe.
Okay.
And we have some pretty interesting projects with them in the works, and they work through our core system. So the days of banks being adverse and pushing that away are gone. If you're not a bank and adapting to the ideology of cryptocurrency, then I don't know what to tell you. Now, you can say that crypto is not going to be here. There might be some government intervention. There could be some regulation. I respect all of that. It's speculative at the moment. But what I do know is that the inherent value in the blockchain is here to stay.
Right.
I think we all can agree that it's going to revolutionize the real estate space.
Yeah.
But what if I told you that banks could change the way they do things like ACH credits and the way you get money from your accounts vis-a-vis their own internal blockchain?
Right.
That's out there. That's a technology that's already growing and building, and there's people who are offering that as a third-party provider to banks. So I've never been adverse to cryptocurrency. I love it personally. Lending on it is still a bit of a challenge and kind of a learning curve. Wyoming has been somewhat of a seminal state in the new law around cryptocurrency, particularly because they have a futures market in bankruptcy now. But it's still unsettled. So I think as it relates to banks, they're going to get on board. I know Jamie Dimon hates it, but they'll be part of it.
Well, I've seen those memes of Jamie Dimon where he's like, Bitcoin's doing this. It's like, Chase is now starting a Bitcoin fund. Like,
I hate it, but there's too much money to not hate it.
I have to allow it. Everyone wants it or they're going to go to a different bank.
Yeah.
That's what it comes down to. And it's just interesting because, like, I would say most people who like crypto aren't doing it for, like, the libertarian type aspect of it. Like, they're buying it because they think it's an investment they want and, they think it's going to go up. They'd rather buy it than stocks. And, then you have those diehard people who are like, no, this is changing the system. We don't need banks anymore. This is going to make everything decentralized. Like, what do you think of those guys?
Well, in some parts, they're accurate. Look at what Robinhood with their democratization of the space, right? Those guys are not stupid. They knew what they were doing, and they got into a space, and they've been able to hold up. Now, their stock prices had some volatility, but there's something to be said for the next generation of people wanting to change this large corporate franchise value that we have in the system. They want things to move around. And I think that's going to happen. I think the blockchain will be way, way more powerful for title, for the way we record things. Think about escrow and stuff like that. But why do we use DMV for titling your vehicle? That's where I think the real implications will come across. But when it comes to cryptocurrency, and I think the people that hold it, if you want to hold that as your monetary instrument, then that's fine. But when people tell me that they want their bank to be involved, I always kind of question that a little bit. What does that mean? Because we all have crypto wallets, right?
Right.
I've got 2 or 3 different versions. I have one for my NFTs on a different blockchain. I've got one for my cryptocurrency, and I've got a couple different places that I hold cryptocurrency. Do I really want to log into a Wells Fargo or Chase or a First Foundation Bank account and see my cryptocurrency there? Or do I really want that separation of church and state?
Right.
And I think a lot of those diehard fanatics, as much as they want to democratize the space and change it, they still want the separation. They're not going to feel comfortable if their bank holds those assets because now the bank is taking that something that's supposed to disrupt the industry and they're bringing it into the industry.
Yeah.
Right? It's not really disrupting anything.
Yeah. Why would you want them to control their biggest competitor?
So the adoption rate, I think, is not going to be as swift as us as banks hope that it will be, but it's too lucrative and too prevalent now to ignore.
Right. And it's only going to keep getting bigger and bigger.
Oh, yeah. And I think the NFT space will too, but I think a lot of times what's in the NFT space at this particular juncture is the early stages. This is so early in that game.
Yep.
People are judging a lot of what they're looking at with JPEG images, but the value in, like, you saw the first piece of NFT traded in Florida, right?
Yep. The first piece of real estate.
In the U.S. There was one, I think it was Ukraine, I want to say, before
know.
that. So I believe it was the founder of TechCrunch who sold it first in the exact same structure and probably the same company that did it that way. And this is the first one in the U.S. But I love that NFTs are first really here now and is prevalent. And I think we're probably going to see several more transactions this year. And banks are going to have to accept that a DeFi smart contract controlling an LLC is something we're going to have to get our arms around from a safety and soundness regulatory perspective as a bank.
Yeah. No, I totally agree. I'm all in on NFTs. I understand that crypto is the engine that makes NFTs work, but I love the NFT space. And, I don't know, by the time this launches, who knows? My NFT might be really close by, but we're in heavy development to revolutionize real estate. So I see the same things you see about how everything will be disrupted by NFTs in real estate, and I'm going to try and be ahead of it.
So there's some interesting models. I mean, you as somebody with Pineda Capital, right? You're syndicating deals, right? You're structuring that way.
Yep.
The NFT is so perfect for a syndication structure. It's unbelievable.
Yeah, it makes any liquid asset liquid.
Yeah, immediately.
Yep.
And you don't have to worry about, I mean, if you know, syndication contracts are really, really complex. You got SEC securities law there. You have to worry about trading disclosures, qualifying your buyers or your investors. It can be very nebulous.
Yeah, you know, for those of you listening who don't really know what we're talking about, you know, the biggest problem with a fund is that it's not liquid, right? So if Chris wants to go invest in Pineda Capital, you know, we got a really good deal. It's great. He loves it. And part of our contract says that he's got to be an accredited investor and he's got to tie up his money for the next 5 years. That's really pretty standard. And he knows that and he's fine with it. And he gives me his money and he trusts me to go do what I do, right? Now, year or two into it, the market goes up. We're stabilizing it. You know, the property's worth a lot more, but his money is still tied up. And then Chris says, you know what, dude, like, I'd really like to get my money back. But, you know, I don't have to give it to him, right? Well, if his share was an NFT and he originally bought in for $100,000, he could go and trade his share on the open market for, or not his share, but his NFT on the open market for what its new value is based on what I've already done. So now maybe his share is worth, you know, $200,000 because we did really good things. The market appreciated, and he can go exit out of it now instead of having to wait for me to go sell the property or refinance or do what we do. So, like, that's just one aspect of why NFTs and real estate are going to be extremely big. And I'm just like, I can't wait for all the possibilities because I know that most real estate people are old school. And me being innovative and pushing the envelope, I can be one of the first guys to do this and really bring it mainstream.
Oh, yeah. And you can be on the precipice of what comes next. So for those of you listening, title, the way it works whenever you get a title policy on your property is it basically gives you an insurance that the person that's selling you the property is giving you a bona fide title, real title to the property.
Yep.
From a legal perspective, what they do is they go up and down the chain of title effectively to when it was created to where you get it to make sure that everybody who sold it in that chain of title is the person who owned it prior to them.
Right.
So you know that if I buy that property from Ryan, it is Ryan's property. Well, NFTs do away with all of that because if who owns the NFT can sell you that NFT right then and there. They can't sell it to somebody else. You already know it's good.
Yep.
So title insurance goes away. And if you can roll a syndication structure into a title-based structure, and now you have property that you can literally buy and sell online with a click of a button.
Yep.
It could literally revolutionize the way the agents do business, the way the brokers do business, the title companies will change. And there's a lot of monopolies and a lot of associations that are in the way of this structure.
Yep. And
I think that's probably going to be the biggest pushback rather than customer adoption.
You know, it's just like Uber, right? The taxis tried to fight them for so long, and you can't stop it. It's going to happen. And I agree. I think title companies are easily the biggest targets. And this is actually something, too, you and I were talking off camera about a new thing I just launched called Wealthy Agent, which is for realtors. Like, the biggest thing I saw with realtors is that, you know, the old antiquated brokerage model does not help them for what is to come in the future, right?
Not at all. No.
The old brokerage says, hey, do more transactions, cold call, do this, you know, get your sales and, you know, just do more because that's how they make money. But that's not what makes you wealthy. What makes you wealthy is buying real estate, seeing the oncoming tech, building a personal brand, you know, understanding tax. These things, the brokerages just can't teach you because they don't know, and it makes them no money. Mm-hmm. And so I'm trying to bring those to our realtors with this. And I'm actually giving it away for free to realtors that join us. So if you're interested, just go to wealthyagent.io and you can, you know, join it. And we're creating this huge education platform, very much like Future Flipper for realtors specifically. But to the point of one of our missions with Wealthy Agent is tech and making agents aware of emerging tech because just nobody gets it yet, but it's coming.
And people should be aware, too, a lot of these So I own a small real estate brokerage myself, and I can tell you that I spent some time looking into other real estate brokerages because I want to know what they have to offer. Not really because I'm interested in growing and scaling with people, but because I just want to see the technology that's out there.
Yeah.
A lot of them will say they're technology-based companies or they have this proprietary tech, and they're not. It's
They
just
have a CRM.
It's just a relabeled CRM.
Yeah.
And they do really good marketing around it, which is funny to me because that's never really going to help anybody get wealthy or grow.
No. As the world starts to go more digital, you need to be aware of which businesses are going to thrive in the future. One of the obvious ones is e-commerce. In fact, last year, e-commerce sales did over $4 trillion globally, and it's continuing to grow. Now, if you're like most people, you probably don't have time to learn a whole new industry and start a new business. But there is another way. You could partner with us at Lunar Ecom. We have over 300 e-commerce stores that we have created and managed for our clients. And the best part is, it's completely passive on their end. The business model is very simple. You cover the cost of creating and running the store. We handle everything else. We pick the products, we handle fulfillment, returns, and customer satisfaction. After all that, we split profits at the end of the month. This means that when you win, we win. If you want to learn more about how it works, you can watch our case study at lunarecom.com. I believe that the e-commerce space is going to continue to explode as the world goes digital. So make sure you're with the right partner who's going to be ahead of those trends. So go schedule a call with my team today at lunarecom.com if you want to learn about how we can start taking your passive income to the moon. Most people want to get rich at all costs. They make sacrifices with their family, their health, and their faith, all in the pursuit of money without even realizing it. But what if I told you it doesn't have to be that way? What if you could grow your wealth in all areas of life? Well, it's possible, and that's why I created The Wealthy Way. It's a community of people striving to grow together in all areas. And we have multiple tools for you to use that are completely free. You can get access to the Wealthy Way Planner, where you can set goals and hold yourself accountable on a daily basis. We also have our Wealth Builder Academy, which is over 4 hours of content teaching you how to manage your time, create the right goals, and all the biggest secrets I've used to grow my life, not only in my net worth, but in all aspects. Lastly, we have our Discord community where thousands of wealth builders are all over the world encouraging one another and growing together. And once again, all of this is completely free. There are no upsells, there are no hidden catches. For me, this is a passion project, and I want to build a community of like-minded people. So if you want to start living the wealthy way today, go to wealthyway.com. There you can get all the free resources like the course, planner, and Discord community. So go to wealthyway.com. Yeah, so I'm excited about it. It's been something I've been thinking about a lot of, like, what's the realtor going to look like 5 to 10 years from now, you know? And why is there this perpetual cycle of these realtors who sell houses but don't actually buy any themselves, you know?
It's incredible, right?
Yeah.
It's one of the most common themes I've seen in the real estate game, and it baffles me. And I see it in the investment side too. A lot of the multifamily guys who are avid multifamily investors, they only believe in that, and that's all they do. But they don't look at things like crypto. They don't look at the stock market.
Yeah.
There isn't this willingness to go beyond what they're comfortable with, and I don't understand that at all. There's no wealth creation in it for real estate agents who don't own real estate long term.
No, you will literally be cold calling till you're 70. Like, it's that's the life, and that's what a brokerage actually teaches you to do.
Well, they want you to. That's how they make money off you.
That's how they make money. And so you don't want to be like that anymore, and you're an agent. Wealthyagent.io. Check it out. Other thing I want to talk to you about is taking the bank public.
Yeah.
It's something you and I have talked about before, because I actually had a couple of stock guys on here, and we were talking about potentially maybe one day taking my companies public. And, he brought up the pros and cons, and then I finished reading a book about why you should never go public. And you just went public, or not just, but you guys have been public.
6-7 years ago, yeah.
Yeah. So tell me about that experience, and what have you learned?
Well, more than just the experience of going public, I can tell you that by nature of what I do for a living and looking at everybody's financials, I can see really deep into some high net worth and some celebrity clients, people that you know to be wealthy's financial picture. And it's, except for maybe 2 or 3 over my entire career, they've never taken companies public or been the benefactor of a public company. It's this long-term legacy wealth, the building of wealth over time, or whether their parents did it or they did it themselves, that got them there.
Right.
but there's also this tangible return on investment over time that you really can't put a number on or value the right way. And I'll point to families like the Rothschilds and the Vanderbilts. We know their financial wealth came from the Industrial Revolution.
So long ago.
So long ago. And to this day, we know them to be wealthy families, generations later.
Well, there's like, what is it? There's all these conspiracy theories about the Rothschilds.
Right? I want one day for our families to have conspiracy theories about why they're so wealthy.
Okay.
Right? So, but that's just how it works, and whether we like it or not, and that's the beauty in the program, the Wealthy Agent IO program, actually, is that you're teaching them that ultimate mindset, which is not given to us in school. Nobody teaches us how to get wealthy. We think the pinnacle of success is going public and monetizing your investment. But think about that. If you're running a company, now you layer in shareholders.
Right.
Now you layer in regulatory oversight.
Yep.
It can become very complex. Now, everything you say and do is under the scrutiny of the public microscope, and that business isn't necessarily any more profitable than it once was under your leadership.
Right.
Now think about it from the stock market's perspective. Every single quarter, no matter what, they want to see improvements. They want to see guidance. They want to see forward-moving growth. And business is not linear growth. Sometimes you have to make adjustments, like the economy.
Take a step back to
right?
go forward.
And if you decide you want to do that, or you want to pivot to something like technology that's really impactful and important to you,
right,
you can unilaterally do that right now.
Well, I thinking of just literally since we talked about Wealthy Agent, I decided in order to start this, I had to shut down Forever Home Realty, my brokerage, to then move the agents over to Real Broker, right? Because Real allows us to go nationwide and do all that. But guess what? Not every agent's wanting to do that. So, I don't know how many we're going to end up bringing over from these initial agents, but it is a step back, at least today, for what I know will be an enormous step forward. But, if Forever Home share price went to zero today, my holders wouldn't be too happy.
Your holders wouldn't be too happy. You didn't have to run that through a board and 6 different committees. You didn't have to go through the red tape that is the corporate and governance and oversight. And from an attorney's perspective, I can tell you that it's a lot easier to make the decisions in the vacuum of your business. And as much as I respect the idea of public companies having boards that's responsible for managing the executive or overseeing executive management, it can become a very political and charged environment. And why bring that on? So you can liquidate your investment? Why, unless your investment is not spinning off enough money for you to continually invest, or you wasted that money, I would say there really isn't a need for you to go public.
Right.
And if you could go public under that set of circumstances, you probably wouldn't go public for much unless you're a very unique niche unicorn industry like Uber, where there isn't a metric for a similar or barometer, and you went public losing money, but you knew you were revolutionizing a space.
You needed more capital.
You needed more capital. You had to do it. But for most people, if you can own a company and build it and scale it and grow it over time,
without the need of other money,
other money, or you can get money from banks, you can get capital other places. There are other ways.
I
to
know
get
of
sources.
one.
Yeah, you know of one. I just wouldn't trust the guy who's making the credit decisions there. But there are better ways. In long term, that seems to be a more proven and tried and true tested methodology for wealth creation for families, legacy wealth for families over time. You can't deny the number of people I've seen create and build wealth that way that still have wealth today.
Yeah. Yeah. When you're talking about these, like you just said, Vanderbilts and like these other companies or families that we don't even know of, right? Because they've just been doing it over time. And I think just with stocks and everything, the media hypes up the Elon Musk and these like great entrepreneurs, but I guess to your point, that's not what's been building wealth traditionally.
Well, no, I mean, Elon Musk is the 1% of the 1%.
Right.
We look at that huge shining star in the sky that's our sun, and it's hard to see the other stars when it's around. But if you pull that out of the picture, there's billions of stars out there, probably more than that.
Yeah.
There's enough to light up the sky, and that's what it is when you see wealthy people around you. Just because someone's not on social media or someone's built a different enterprise or they're quiet about it doesn't mean they're not out there and not everywhere. Every time I drive down the street, I walked into this building when I came here, and I love walking around neighborhoods because I wanted to see all the businesses that were around. And to this day, I still fall in love and get enamored with the idea that every one of these commercial spaces around here have a business inside of it, and somebody owns that business.
Yeah.
That's money being made. That's somebody's livelihood being ran out of that space. We tend to, I guess, fall out of love with the idea that businesses can really build something, and we just want money so badly that we lose love for the building. The building is really what it's about.
I wonder why, you're speaking of space, like why Elon hasn't taken SpaceX public.
Well, if you look at what he's dealing with from a public sentiment of Tesla and some of the things, so he got hit by the SEC for making public statements that impacted the shareholder value. And then he pulled the ultimate jab right across the bow at them by the cryptocurrency. So he put a lot of cryptocurrency on his books. And then what did he do? He wasn't manipulating his share price. He was manipulating the value of cryptocurrency, which in turn manipulated his share price. So that was strategic for a number of reasons, I'm sure, and I can't claim to understand the finances, but you have to know he took a lot of pride and joy in messing with the SEC. Plus, there's government contracts in that space. I can't imagine that after Tesla, he really wants to take another company public.
And that's the point, right? Like, he doesn't need to now.
No,
he's the richest man in the world.
Yeah,
like,
why would you want to do that again?
Yeah.
And he can liquidate at any point in time now and cross-invest however he wants to, but his perspective is going to be so unique.
Yeah. No, it makes sense. So why did you guys go public?
I think that's what banks think they're supposed to do. And frankly, that it's a sign of a strong bank. I think the consumer sentiment around a bank that's private and a smaller community regional bank loses its luster and shiny, coin object piece to it.
Gives you more reputation. Like,
there's a little more
public.
reputation. Yeah, you can look it up. You can go to, any stock exchange, trade our stock. You can buy into it. It just gives us a little bit of that brand value. And as a bank, I think there's a lot of value in going public. I'm not going to take that away. I wouldn't say that I wouldn't do it again. But for any of my companies, any of the stuff that I do in the future, I can't say that I would ever do that.
The bank is a unique situation.
It's a unique situation. When you think of a bank, you want somebody that's like that and out in front of you, and it adds value to them. There's an intangible value to a bank being public because you get SEC filings, you get all this information inside.
You can trust that your money isn't going to go away.
That's what everybody said about Lehman Brothers, I'm sure.
Yeah.
But in theory, they are more regulated, they are highly reviewed, and now you have access to that via public filing. So it should give the consumers more confidence that the information about the inner workings of the bank is out there.
Right. So let's talk about a bank real quick. My perception of a bank growing up used to be that, the bank, they pay me interest, they go lend my money out, and they make a higher interest, and that's how they make money. But that's not how they make money. Like, as far as everything goes. What would you say are the biggest money makers for banks?
Well, it still is the net interest margin, which is the difference between what they give you on loans or what they charge you on loans and what they give you on deposit. But banks have a lot of auxiliary fees on things that you can already tell every single day, like your checking account fees, your overdrafts, all that stuff. But really, the money is largely made there for the community regional banks. As you get to larger banks that have hedge funds or investment banking groups, they can make significant amounts of money in those transactions. But I would say that still to this day, the number one generator for banks has been the net interest margin, and you're going to start to see that increase significantly as interest rates rise. Mm-hmm. We're walking into this interest rate increasing economy. I think we've all accepted that the Fed's going to increase interest rates in March, and when they do that, it's going to be an immediate bump to the adjustable interest rate loans, like the business lending that banks have out there.
Right.
But really, those lines of credit, those give a huge responsive bump to banks because that interest rate will adjust almost immediately because it's an index plus margin. So anybody who's got a line of credit for a business, stuff like that, banks make a lot of money there.
Right. So I guess my point when I was younger was that, you lend, they're going to lend what they have in the bank, which obviously isn't true.
No.
And then I started reading about, I forget whatever you call it, but hey, they only got to keep 10% deposits.
Yeah, capital requirements, limitations.
Yep. And so that's kind of how it used to be run. And then it became during COVID, you don't have to have anything. Like you don't literally have to have any money in the bank, and you can go make loans, and it does not matter.
So the regulatory environment around COVID got very lackadaisical, and I think people were freaking out. And I would say the PPP program and all those programs were a great program in theory. We all know in retrospect how much fraud and manipulation went on there. So yes, banks can absolutely leverage up their lending. So in theory, the way it works is this. I make a multifamily loan for $10 million. I can pledge that loan and get more money on it. So think of pledging that note as an underlying collateral to somebody else, like the Federal Home Loan Bank, for example, and they'll give me 50% of that note value, and I can re-leverage that up. So you can continue to lever up your lending that way as a bank and continue to make more money. There's a lot of regulatory requirement about how much leverage you can take on, and there's several ratios that the regulators will look at, but that is a very, very common practice. So I think the mindset that banks are just taking your money and making loans against it is very antiquated. There's a lot of vehicles for them to re-lever up and continue to lever up and increase this leverage. But after the Great Recession, the Dodd-Frank Reform Act came out, and the regulators started to change their perspective on leverage lending like that, and the limitations are pretty well spelled out. So you really can't over-lever yourself. The only thing that really takes a bank down or really can hurt them these days is bad loans. Really, if loans go bad, banks have trouble. If loans don't go bad and their credit quality is good,
They can essentially just lend
in perpetuity.
Yeah, like there's not any limit. They don't have to go raise money from somebody to go do it, do they?
No, but you have to raise money for capital. So your capital ratios have to fall into a certain tier. But keep in mind, that's a low percentage of the actual money you're lending. So
Right.
it's very easy for a bank to raise $50, $100 million, $150 million in capital and then have wide open lending ability for the next, call it 5 to 10 years.
Exactly.
So you don't need a pari passu dollar for dollar funding round. You just need to hit that capital requirement. And to give a perspective on that, 8% would be well capitalized under the FDIC guidance.
Yeah, so like, I guess for me, I'm thinking about it like, does it really matter to have even a millionaire like me at the bank? Like, is it that big of a deal?
Yeah, absolutely. Influence. Think about it this way. Tied to you is more than just your deposits and your cash flow. It's your
And
business.
that's what I'm thinking of it. I'm like, are my deposits really that valuable?
Yeah, of course. I would say that the banks would find it inherently valuable because, number one, your deposit relationship is kind of the core relationship that we work off of, right? But it's a holistic approach. The community banks like ours, it's more of a relationship nexus.
Right.
The more people we have in the community like yourself, if we do things well for you,
I'll talk about you guys.
you're going to talk about us. You're going to say, hey, I had a great experience, and you're going to tell everybody. If we do something bad for you,
I'm going to tell everyone.
you're going to tell everyone. But unlike a chat forum or Reddit forum, you're telling everybody in the business community.
Yeah.
So it's imperative on the smaller community banks. Now, unfortunately, you don't get that same love at like a Wells Fargo, a Chase, a B of A, because they could care less.
I'm a nobody to them.
We're all a nobody to them, myself included. And I can't tell you how many times they've declined me for loans for having too many loans, but that's not my own personal agenda aside. You do value the community banks, and it does make a huge difference to your lending relationship there. Plus, you get a single point of contact in an individual. So, yeah, banks really do value you. And as a millionaire, if you have more deposits with a bank, you do have more leverage to negotiate nuance-based things for you. They will take the effort and energy to understand your needs as a business owner and as a property owner and as an investor to try to find something that works for you.
Yeah. No, that makes sense. I mean, I have had much better experiences with the community banks. Like you said, I hate Wells. I still have them, and they just still to this day, they don't respect me.
I have Wells too, and I hate it because I'm too lazy to move my own personal assets, but I got to do it.
Well, the problem is I have so many accounts, so that to switch them all would require so much change on the auto pay, and like it's a nightmare.
It is a nightmare, and that's why people don't stay. It's a very, very sticky business, and that's why when there's a run on banks and people ultimately pull their money out of nowhere, banks are totally caught off guard by it because that's not a very common thing.
How often does a run happen?
It hasn't happened since the Great Recession.
I was gonna say that used to be a thing.
Well, it's funny because on a national media scale, it really only happens in like large recessionary like economies. But on a smaller community basis, if there's a bad reputation to a smaller community bank, or somebody has like an entrepreneur like you has concerns about a bank's financial wherewithal, and these small chat forums and Reddit forums, they can really impact people's confidence. People can pull their money out right away.
Right.
If someone, if your business partner down the street or somebody told you, hey, look, this bank is having some issues. I walked in there. I didn't like what I saw. You as a business owner are going to go, wait a minute, I can't lose my money. And you're going to pivot. That can happen pretty easily for some of the smaller banks. But for larger banks, it almost never happens anymore.
Interesting. So, my perception of banks was like what I said growing up. Then I read a book called The Creature on Jekyll Island. Have you read that book?
I have not, no.
Okay. So it's kind of like I don't want to say it's a conspiracy book. It gets labeled that, but they kind of talk about just like why banks exist, how we got off the gold standard, the dollar and all these things.
Yep.
And it made the point that started to become more apparent to me of like, dang, this might not be a conspiracy theory when we printed all this money for COVID, right? And it basically was saying that we live in this environment where we have to continue printing. There's no going back at this point. And the only way, well, not the only, but the biggest way that the U.S. prints money is through the banks. And I started to think about it, and I was like, yeah, that makes sense, because if you just think about a loan in general, like, okay, this didn't exist. And now all of a sudden, you go make a $10 million loan. It's now into the world. That 10 million went somewhere.
Yep.
And it came out of thin air.
So I've got two kind of thoughts on this. My first thought is this is why I don't understand all the stigma around cryptocurrency. Effectively, the US dollar is digital right now anyway.
Right.
Then cryptocurrency advocates will say, well, Bitcoin's great because you can only mine a finite amount, and then after that, it's gone.
Yep.
What does it matter? We don't do that with the US dollar anyway. You could, in theory, if you want to, again...
They just changed some numbers on a screen, and now...
There's more dollars out there. You could mine in perpetuity,
right,
if you will. But the other side of me says, why... As much as I'm a historian of the banking side of the business, and I love and appreciate it, I tend to not dive into any of that, even though I know it affects me. I know that banking the way we do it today will eventually become obsolete. And before we started this, I was telling you off the show's cameras that I've moved largely into real estate myself over the last 12 years or so, and I continue to do so because I don't want to think about it. I don't want to have to worry about my assets.
Right.
I don't know what's going to happen with the US dollar. I don't know what's going to happen with cryptocurrency, but I know what's going to happen with real estate.
It's going to be here.
It's going to be here.
You're going to have a house.
And I know that so many people that I've seen over the years have this robust real estate portfolio, and they live very nice lives that I would aspire to.
Right.
I still am aspiring to, on some level, the lives that they lead. So I try not to dive into the rationale behind it. I just try to make sure that I play the game by the way the rules are supposed to be played. I try to understand. That's how I got in this job, is just trying to understand those rules.
Right.
And trying to master them to the extent that I can. And I don't fight against the system. So if a lender tells me no, as somebody who's in the space, I find a lender who's going to tell me yes, or I take the L and say that I can't do it that way. Let me find a different way to do it, and I move on. It's never easy. There's always challenges. You know this business. It's always difficult, but you'll find a way, and that's all that really matters.
Yeah. No, I'm with you, dude. Yeah, it's just interesting to see, how this is playing out just since COVID, and whether it be grants and PPPs or, just printing more money or crypto. Like, there's so many things happening now that we're like finally hitting that acceleration point where things are starting to happen a lot faster. So it's going to be interesting to see how it plays out.
So elasticity in the economy is a huge, huge thing that people tend to overlook, right? You can't have 14 years of artificial interest rate deflation. Typical recessionary economies last 7 to 10 years from trough to trough, right? From peak to peak. And we've been in 14 years, double the low end of that space.
Right.
Artificial interest rate deflation, a worldwide pandemic, a PPP program that was unprecedented, government stimulus in a way that we've never seen before, eviction moratoriums, and for the first time in any recessionary economy that I can recall, and going back to 1929, there was always a dip in real estate values that followed immediately after the beginning of a real estate cycle.
Right.
I think we can all admit that we are in the beginning of what is a cycle, a recessionary cycle. But is it going to be a real estate cycle? I don't think so. I mean, housing supply issues are there. Now, is refinance volume going to drop off? Yeah, maybe. But housing values are not going to go down. And if they are going to go down, it's not going to happen overnight. It's going to be a very prolongated thing. And why? There's no elasticity in the economy. You can't pull the rubber band back all the way for so long and just let it go and expect there not to be repercussions. Well, the repercussion is it's going to take a lot more energy to get momentum back in the economy. And all these things that we're seeing now, in a normal, healthy economy, they may have moved the needle a little bit. The biggest tell I can tell you right now, people being really afraid, people who really know the business, we haven't even seen the interest rate increase right now, and you've already seen the treasuries rise significantly. You've already seen some mortgage companies with layoffs, and second round of layoffs in some cases. You've already seen the implications of a real estate refinance change, the landscape changing, while values are still high, while it's still super hard to get a home. This is unprecedented times. No one knows what happens next.
So you mentioned, obviously, we think that rates are going to go up.
Yeah.
I mean, what's your prediction?
I don't know that I have any value on this, but I looked at the Bloomberg Probability Index, which has several hikes built in. There's a high probability. I think it was north of 90% last I checked. There's some general consensus there will be a interest rate increase of at least 25 basis points in March. Some people are saying 50 basis points, and some people are saying up to 6 interest rate increases this year alone. I don't know. And I'm not going to say that I'm smarter than someone like Mark Zandi over at Moody's or at Bloomberg and their team of economists. What I will say is I know there's going to be an interest increase in March, and I know that treasuries are rising and reacting already.
Right.
I know that the $4 trillion market cap of single family is coming down to $3 trillion. And those are approximate numbers. I want to say it's almost a 35% drop is what they're predicting for the space. And if you want to go by actual
What do you
numbers.
mean that the market cap's going to drop?
So the actual real estate volume, transactional volume,
Oh,
refinances,
transactional
purchase,
volume.
yeah.
Okay.
So a lot of the mortgage companies in the space will look to that as
Okay.
their kind of moniker of where they're going to wind up. And we all know that the mortgage companies and lenders out there, the non-bank lenders in particular, are really, really refinance heavy.
Right.
So to see them anticipate that level of a drop off, that means they're going to have to consolidate. And the only
Yeah.
way they consolidate is human capital, because that's
Right.
really what that business is.
Right.
So I know that I'm seeing all of that now in advance of that. I think you see a 25 basis point increase. And I think, unfortunately, what that means is you see a pretty visceral response to some key businesses.
Yeah.
Non-bank lenders are going to get hit. I think the purchase and sale market's going to have some change in the landscape. And I think you see more increases this year.
Yeah.
But I don't know if you're going to see it the following quarter. I think they may wait because of whatever visceral reaction we have. Because, again, it's been a long time.
Yeah. So I'll preface this for those listening. By the way, if you're still here, shout out to you guys. Make sure you leave a review on Apple, and also subscribe on YouTube. But I look at this pretty interestingly, not as an economist or anything else, just talking to smart people, and I guess I do have an economics degree, so maybe I am an economist.
There you go. Yeah.
But I look at this from my own biased, subjective view of what I've just encountered in my life and talking to people. I see, I had Grant Cardone on a few months back, and his bet with me was in November, interest rates would be lower than what they were in November of 2021.
Mm-hmm.
He's taking the opposite bet. Right now we're filming this. It's February. By the time this is released, it might already have happened. Okay. So everyone knows that these predictions are in February. Everyone's talking about this rate increase, but now we're talking about World War III, right? Like,
I know. Wow. Right.
I don't know. It just seems like something always happens that keeps kicking it down the road. And, oh man, well, we got this going on. We can't raise rates with all this stuff going on in Ukraine. I could totally see that happening.
I can too. And I've had this debate. So Scott, our CEO at the bank and a very close personal friend of mine, he takes that same stance, particularly now in light of the Ukraine incident and the excursion and all that. I would say it doesn't matter. That wartime economies typically post-wartime have actually
They boom. Yeah, no, I know that. Studying history, I mean, World War II was what got us out of the Great Depression.
Absolutely.
So war is good for the economy, bad for human life, obviously. But to me, it just becomes this thing again. Like COVID was bad for human life, great for the economy. It allowed them to print money, which is exactly what happened in World War II. And I'm like, man, is it a coincidence this drama's happening again? Like, I become more of a conspiracy theorist every time. Like, it just keeps hitting all these conspiracy theorist ideas. And I'm like...
It's undeniable, yeah.
Yeah, I'm like, man, maybe these guys aren't so crazy. And, like, maybe these guys are getting banned on platforms for good reason. Well, not good reason, but, like, they might be right. And, yeah, I don't know, man.
I read a fascinating article a while back, and I'll try to find it and send it to you, about the psychology of prosperous economies and some of the propensity to go to war to build up prosperous economies. There's a correlation there. I would also say that at the top of very prosperous economies, it's not uncommon to see people who will just absolutely not believe that the other side is coming. And it's hard to tell because this is such an unprecedented economic event that I don't think you can look back on it and let history be your guide forward as to what is coming next. But it's undeniable that this war throws a massive wrench at the Fed right before a Fed decision is supposed to come down.
Yep.
And it's undeniable that now you have a political environment with the president who is supposed to be monitoring and doing something about this, who's going to have some influence on that decision, at least in theory.
Yeah, well, what's interesting, too, and I was thinking about this, whether you guys like Biden, hate Biden, like Trump, hate Trump, it was like Trump got criticized for being buddy-buddy with Putin, whatever you call him. And everyone's like, dude, why is this guy being buddy-buddy? And all of a sudden, it's like, all right, now we get Biden, who's like, no, dude, like, we do not like We don't like him, blah, blah, blah. It's like, well, now we're at war. Like, you know, like,
Yeah.
you know, who was taking the better approach? Like, at the end of the day, look at the result of now what we're about to face.
Well, if we have a North Korean excursion anytime soon, then I think you can pretty much shore up the fact that somebody's tactics were better than another's. But
Yeah. I mean, that's the point. I don't care what anyone, like, at the end of the day, you're judged by the results. And, you know, whatever happens from this, we're going to find out.
I won't get political, but I will say that I find it funny, some of the stuff coming out of the White House right now as demographics and infographics that are coming out. Look at their Instagram. It is such skewed data that it's trying to show the strength of the economy when I would say the data behind it is manipulated or taken in a different context to make it show that it's stronger than it is, or that it's we're placing so much political energy on the economy that it's really disturbing the picture.
Yeah.
And now with the war going on, I turned on the television the other day and I didn't see anything about COVID. I didn't see anything about business stimulus. I didn't see anything about small business entrepreneurs anymore. Now it's all about a war. And I can't help but wonder if the die down of the rhetoric as it relates to the economy and everything else, is that going to take pressure off the Fed?
Yeah, no, I mean, that's my point, is like, the more I see it and the more you hear these guys, you're like, dude, like, these guys are right. Like, the Fed, or not the Fed, but, you know, media manipulates things, like, and they have an agenda, not from themselves, but from something far bigger than them to, you know, push a message. And it's like, well, at least, I don't know, China and Russia are transparent that, yeah, we have state-run media that, like, it's for sure propaganda that we all know is their message and their version of it are getting, but it's like, I don't know, I think in the U.S., there's a lot of that we feel it's free speech, but is it?
It's free for them to say, but it doesn't mean it's not without motivation. And that's one of the things that's, I don't know if you've seen Dave Portnoy's, he's attacking the media right now.
Okay.
He's been attacked on several times, and he's been going after Business Insider for some of the press that they put out right before earnings and earnings calls and right around that time.
Yeah.
And he's effectively accusing them of manipulating the markets and having a personal attack on them. It's a very fascinating time from a media perspective because social media now, we can be our own.
Yeah.
PR
I mean,
marketing.
nobody trusts legacy media anymore. I mean, that much is certain. And Trump brought that to light. That was his whole thing that got him elected.
Well, does anybody really watch it in the amount that they used to? Look at Joe Rogan's viewership. I guarantee you that's got to be 3 or 4 times more than traditional media.
Yeah. And look what happened to Joe Rogan.
Yeah. And yet Spotify backed him.
Yeah. But they tried to take him down.
They tried to take him down.
Yeah.
But they couldn't. And I would say that's going to be the paradigm shifting in the influence world. And that's where people like you who have your platform are going to really level up in the next, whatever the next economy is, that economically isn't going to stop your ability to reach the masses and continue to grow your business.
Yeah. So guys, don't get me banned from me talking about this, but we're keeping it real around here. But anyways, dude, it's already been an hour. I could talk forever, but man, that was a great episode, dude. Super insightful. I'm glad we got to dive into my conspiracy theories live. But yeah, man, keep crushing it, dude. We didn't even get in your real estate, but man, you're doing some really big things, and I appreciate you coming on, dude.
Yeah, next time, man. Thanks for having me. I appreciate you.
Yeah, man. All right, guys. Thanks for watching. We'll catch you on the next one. Peace. Thanks for watching The Ryan Pineda Show. If you want to work with me, head over to ryanpineda.com. You can find my courses, coaching programs, and upcoming events. We also have free resources you can download, so head over to ryanpineda.com.